10th. And today we have Stewart Title on, and they are going to discuss they're going to break down the new anti-money laundering rule that came out. They had a Zoom meeting about 2 weeks ago, I think it was. And if some of you attended that, that's great. Some of you didn't, you'll learn all about it today. So this is Catherine, and Jules will also be on to talk about this for you. So just wanted to let everyone know we're glad you're here. Okay, go ahead.
Okay, thank you. Hi, everyone.
Oh, one more thing. Sorry.
Yeah.
One more thing.
Yeah.
Jeremy is monitoring the chat box. So
Oh.
if you guys have any questions along the way, Jeremy, if he feels it's pertaining to that immediate subject that you're talking about, then he'll probably pop in and say, we have a question. Okay?
All right, perfect.
And by the way, as always, this is recorded. So it's everyone's, if you want to check it out, or if you want to revisit this one, it's uploaded in Sweet Assist and even in Facebook. So without further ado, you may take it away, Catherine.
Oh, thank you very much, Jeremy.
Yep.
Well, we really appreciate being part of your huddle this morning, and we want to make sure we add value to your busy schedules. And because, March is here, and I feel like right after Super Bowl, it kicks in and our market starts to pick up and get busy. So I will introduce myself first. I'm in business development for Stewart Title. I've been in my career for about 22 years. I love what I do because I love people. So I am always happy to connect with you outside of this meeting if you would love to learn more about Stewart Title locally in Minnesota, nationally, and globally, because we kind of cover it all as an underwriter. But it's funny because some people think we're just an underwriter and we don't do the title and closing. But yes, we do the title and closing, and we would love to work with you if we haven't already. National Realty Guild is really wonderful to us, so we're very grateful. Julaine Setter is our escrow officer, and she is somewhere on here. I saw her pop on, and maybe she's here. Julaine offers about 25 years of experience, and she's an escrow officer residential. She's just kind of like a walking dictionary of information. She's so intelligent. Her escrow officer is Sonia Brown, and Sonia has worked with her for close to 25 years as well. They make a really great team. Before I forget, and before we start the topic of the FinCEN, I just want to let you know that our Bloomington corporate office is moving to Edina on France Avenue. The Centennial Lakes building complex, March 23rd, will be in our new space. In addition, we have Arden Hills, Woodbury, downtown Minneapolis, Mankato, but we can also fill in and do closings anywhere. But we're really excited. We're right on France Avenue, 7701, and right inside the door, Suite 100. So anybody that wants to pop in our office and say hi after March 23rd, we will welcome you anytime to check out our new space. Jules, are you there? I see her there. I think she's having some technical difficulty here, so thanks for your patience.
She's unmuted.
Yeah, I don't know what's going on, but she originally was on. I saw her picture, I heard her voice, and then something happened. So, Jules, what I'm going to do while we're waiting for her is to just read an overview, kind of that this.
One second, Catherine.
Oh, good.
Yeah, I was just going to tell Jules. No, I was just going to tell Jules that if you can't get on with your computer for some odd reason, you can always use your phone. I mean, set it up, and that's just a different avenue that I've used before when I couldn't get on. So you could at least try it, because we hate to not be able to do this without you.
Oh, absolutely. Okay? Jules is the key proponent here, because I know enough to be dangerous.
Well, I just know that you're planning on her doing it, Kathy.
Yeah,
Kathy, I'm sure you know just as much, but
yeah, I'll read an overview that she had kind of sent my way one day when we had one of our realtors say, I recently attended one of your webinars where an attorney presented, and we just kind of want a smaller overview of what we need to know as realtors. And so I'll kind of read what Jules had put together until we hear her chime in. Okay. This is in reference to the January or the one that we just did a couple weeks ago. We're putting on the FinCEN presentations to help agents get up to speed on the changes at the federal level. The reason why we're looping agents in is that if their clients have certain criteria, buying or selling in a trust, transferring into a trust, buying or selling as an LLC, etc., buying using non-traditional funding like a contract for deed or hard money lender, they could be subject to additional information requirements by the federal government. You'll be seeing potential FinCEN requirements from any title company that you use. It's not just a Stewart title specific issue. The federal government is cracking down on real estate transfers, like into and out of trusts, LLCs, etc. It's a new requirement for all transfers, and many title companies may err on the side of caution and send out the info requests if there's any part that may qualify as the penalties for non-reporting, which is technically the title company's responsibility. The penalties are steep, as much as, in parentheses, she put $1,300 for a nonprofit, $250,000 if there are multiple non-reports, and if you aren't reporting at all possible, 5-year jail sentence. So, I mean, it is a scary thing, but it's real. As the agent will not need to deal with the requirements, but we do the webinars, events, and social media outreach as an overview, as agents may want to be able to explain to their clients why they're being asked to fill out very extensive information requests and pay the FinCEN fee to have it processed if their transaction qualifies. In addition, Stewart created its own separate division called FRS, Financial Reporting Services. It's been created as a separate division of Stewart to handle these transactions. And we're happy to share our flyers and resources with you. For now, Stewart, we've got a Stewart Title Resource Hub so that you can review it, learn it, and move forward with confidence.
All right.
There she is. Perfect timing. I just finished my little overview so you can go into the real nuts and bolts of it.
All right. Hang on one second. Yeah, I know I'm overdubbing there because I decided maybe I should just go onto my phone. And then of course now this works. So here we go. All right. Can you guys hear me? Okay, perfect. So FinCEN, we're going to talk about that. Financial Crimes Enforcement Network. And I know you guys are thinking why it shouldn't really matter to me because you as agents aren't going to be the ones that are reporting. But let's go through some of the reasons why it does matter to you guys. And I guess one of the biggest reasons that it matters to you guys is that you're going to need to know as the agent, if you're accepting offers or if you're thinking about accepting offers or you're accepting clients, what those implications are going to be for you in that respect. So to back up a little bit, FinCEN, it's always been around. I kind of liken this to the FERPTA. You know, nobody ever did anything with FERPTA before, and now, you know, we all have to do the FERPTA, whatever. FinCEN also has always been around, but it is something where they are now requiring us to do something with it. It's one of those things where the government finally decided that nobody's really adhering to the policy. So now there's going to have to be an additional layer of somebody's going to report, which is going to be us. So and basically what they're trying to do is keep people from laundering money through real estate transactions. I mean, that's what the whole thing is about. There's a whole lot of things going on with it. What you guys are going to need to know as agents is if you're representing a buyer, are they buying in a trust? Are they buying in an LLC, that sort of thing? Because
with this reporting, what the thought process is federally is that they need to know who is actually benefiting from the transaction, which sometimes and can be, and a lot of times is hidden through buying in an LLC or buying in a trust. So what's going to happen is there's going to be a layer of reporting in there. This is a buyer-driven thing, by the way. So it's on the buy side. If the buy side is buying in a trust, if it's buying in an entity, an LLC, a corporation, that sort of thing, that's what's going to trigger the FinCEN idea that we're going to have to, as title companies, start looking at it and going, is this going to qualify for a FinCEN reporting? The biggest thing about that is that you just have to remember that the reporting is based on cash transactions, or what they call like a regular bank or a regular mortgage company. They're all under the SAR report, which is the suspicious activity report. Most of them are. So if you have somebody that is an investor that likes to buy with either cash or hard money is going to be something where it's like an investment group that loans out to usually flippers, that sort of thing, short-term, high interest. They don't actually do the background that a regular bank would do. So if you have someone that's buying in a trust and they're buying with money from like Wells Fargo, Bank of America, you don't need to worry about the FinCEN portion of it, because the thought process at the federal level is that the bank has a higher level of reporting requirements on their own. So the bank's already collecting that information. So we don't need to do it on this side. They're already doing it. Now, the information we're talking about is pretty extensive. I'm just going to flash it by you guys. You're not going to be able to see a lot of it, but just to let you know, this is 1, 2, 3, 4, 5 pages, all to be filled out. This is why it's a big deal on the side of the title companies, and why title companies like Stewart or a lot of the bigger title companies have actual departments that are taking care of this, because what's contained on this is buyer's information, IDs, social security information. And then if it's say it's a trust, it's not only the information about the trust, like what is the trust, even if the trust is under the person's social security number, it's the trustee's information, their personal information, so their social security numbers, all of their contact information. If you have an LLC, the beneficial interest or beneficial ownership gets triggered. So say you have an LLC that's buying, and this is where I think it's going to be a bigger deal for you guys. I mean, we do see trusts where they do buy with cash. That does happen. But most of the time, if people will buy with a loan. And then if they have a loan from a qualified lender, set amount you charging. Yeah. Is that charging when you have to do the FinCEN reporting? Yeah. Stewart Title's charging $199. It's all over the board what that money is. I think that the FinCEN, I don't think it costs a lot for to send it into FinCEN. If it costs anything, I'm not entirely sure if it does. But what you're actually paying for, I know I'm doing one right now where it's going to have to be reported. It's a double deed thing. It's a relocation thing. So that's a whole thing. I'm actually representing the seller. But on a relocation, that's actually a reportable deed. So Results Title's charging $300. So it's going to be all over the board. And really what they're charging for the person to go through and verify all of that information that's contained on that. Some title companies will use those paper forms. A lot of us, like the bigger ones that have a department, Stewart has their own department. I don't know if Results does or if they have their title people do it. They also have a portal that people are going to go in through. And there's, you can, on the Stewart portal, the way we're doing it, the people can just go in and pay through the portal. So it doesn't need to necessarily show up on your on the settlement statement, but you guys, for your purposes, are going to need to know that when you're doing a net benefit sheet for your buyers, if they have an LLC or a trust, I would go ahead and throw $300-400 on there as a FinCEN reporting, because it's never bad to overestimate what their costs are going to be, right? That's just a thing. That's it. If they're going to buy in a trust and they're going to use cash, use a hard money lender, get a gift, like if it's being gifted to them, so it's not really a monetary transaction, but say whoever grandma's gifting them, but they want it to go through like a title company process, that's also reportable as a straight up gift. It's reportable. So you're just going to want to disclose that to them, so that they're going to know that that money's going to come off the top. They're going to either pay it themselves or it's going to get paid on the Alta. I would say it could be either, truthfully. It's going to be a charge, whether it's going to be charged more like the credit report where they're going to pay it ahead of time, or whether they're going to pay it on the Alta will depend on what title company they're using. And even small title companies are not going to do this for free. The estimate of the average time that it takes to get through all of this stuff and to verify all of the information and to help the people, because people are kind of flailing around going, what do they need here? I don't know what information they need. All of that is about 6 hours if you have to FinCEN report. So that's why even a small title company, if they're going to have them do a paper filing of it, they're going to charge some sort of a fee. Whether or not that gets charged on the Alta, it could get charged on the Alta and put on as a POC. I guess that's, it's probably going to end up there as a POC, because really it should. They did pay it. It's part of the transaction. And I'm thinking that, because this is all new. I mean, this is just, we're not even 10 days into this. I'm guessing that if title companies aren't putting it on there, even as a POC, that we're probably going to start, because I think that we're going to want documentation on our side showing that we actually did, like there was a charge for it. FinCEN, it was all in there, right? It was all collected for. Nobody else paid that. I'm assuming if somebody else paid it for them, that might be a problem too. I don't know. It's all about documentation. You guys know that. It's all about the CYA. So I'm assuming that title companies would want that on there. And you guys would as well, just to show that, yes, we understood that this was a FinCEN reportable, and that that was collected for at closing, whether either ahead of time or through the actual Alta from the numbers at closing. It kind of puts, it's going to be a weird thing for you guys too, because even if it's not your buyer, so if you're like, well, it kind of doesn't make any difference to me because I really only do listings, right? I only do the listing side. Well, it does make a difference to you if they're accepting an offer that's going to be a FinCEN reportable, because part of those documents, that 5-page shenanigan that I just showed you, the seller, if it's reportable on the buyer side, there is a piece that the seller does have to go in and fill out as well. So if, like for our purposes, we have a portal, if it is a FinCEN reportable, what's going to happen is the buyer's going to get a link to the portal. The seller's going to get a link to the portal to where their part of it that they have to fill out is. They have to fill it out as the people that are selling, so that all the transparency is there. One thing to note, this is strictly a buy-side fee though. If it is a FinCEN reportable, that's all driven by the buyer and what the buyer's doing, if they're buying in the LLC or they're buying in the trust. So the buyer is the one that's going to pay that fee. So, if your sellers are like, wow, we'd really like to, accept that offer, but we don't want to pay any extra money, because they're going to have to report, because they're buying in cash, they're buying with a trust and they're buying in cash, or they are an LLC and they're buying our house. Just let them know it's information that they're going to have to fill out, but they're not going to get charged for it. And I know that sometimes buyers or sellers are a little bit like, well, I don't really want to give that information to anybody except my own title company. The reality is that the state of Minnesota requires a certificate of real estate value to be put in. So it's not like you can sell a house and not give your social security number. We've had people that don't have that don't have a mortgage or anything, and they're like, "Why do I need to give you my social? You're not having to get a payoff for me. Why do you need my social?" Well, because the state of Minnesota requires the counties to collect that information, probably as a precursor to this, just making sure that people are being honest in what they're doing and not, trying to catch people that are not doing the right thing. So the process, like which process, the FinCEN process, is that the question? The FinCEN process. Okay, so yeah, the FinCEN process is new. This is something that, once again, the feds have had this around forever. They've just never made people and anyone except the people who are within the transaction. Technically, you're, supposed to be giving out information if they request it. They've never really done that. Even if they use the right to rescind, the FinCEN will not be refunded. Yeah. So if for whatever reason it turns out that because some of these too, like some of these, we as title companies we might not know, is this really FinCEN? Does it really qualify for FinCEN? So we're all going to err on the side of caution because the penalties are pretty, steep, and you don't want to be the title company that's caught going, well, that doesn't seem like it would qualify. So even if it's not, you're not meaning to not, disclose, you just accidentally don't because you don't think that certain things qualify. You don't want to be that title company. You don't want to, take those fees. So what happens if it goes to FinCEN and it doesn't, for whatever reason, if it doesn't close, or if it turns out that it really doesn't, it's not a reportable, that money that they paid up front is refundable. So APR, if they have a loan. So, okay, let's talk about that for a minute. If they have a loan, and that's the biggest thing for you guys to remember. I mean, people don't need to panic about this. I think there's been a lot of panic amongst all of us about the FinCEN thing. But what the really big takeaway is that if the people have a loan with a bank, with a mortgage company, even some of the mortgage companies that are smaller, the way that the federal government is having us deal with that is if we don't know if they are, basically for these lenders, the way that they are exempt, the people are exempt from having to do FinCEN, is if the lenders are either under the FDIC program, which would be your basic lenders, or the NCUA, which would be like your credit unions. Those guys are all subject to the reportable, the suspicious activity, all of that stuff. So that's why the federal government says if they're taking out a loan with one of those type of entities, we don't need to do the FinCEN reporting because they're already doing it, right? They're already collecting that information to get your loan done, and they are already under the onus of needing to report anything that they see as a suspicious type of situation. So I would say that in terms of putting it under like the loan or the APR or anything like that, probably not, because if they have a loan, it's not going to be reportable. Now, the only kind of a weird twist to that is if you have, like, say, two siblings that want to buy a cabin, and one of them's bringing in, I'm kind of monitoring them as they're coming up so we can address them as they're coming up. So if you have two siblings, whatever, they're trying to buy a cabin, or four or whatever, and two of them are taking out a loan for their piece. Let's say four. Two are taking out a loan for their piece. Two are buying in cash or bringing cash to the table for this purchase. Those two are going to be FinCEN reportable of their own, in their own part of the process. So that's going to be a weird wrinkle. I don't think you'd need to do an APR on that or put that into your numbers for your lender, because technically it wouldn't be them that's paying it. And I think that if they are both on the same, I could be wrong about this, but I think if they're both on the same transaction, I think it's one FinCEN charge. So as a title company person, if that was the case, what I would do is I would say, well, you guys need to pay for this. You two can split it because you guys are the people bringing in cash. The two people that have loans with regular lenders aren't a part of it. They don't need to fill out anything. And it's only the people that would be bringing the cash to the transaction that would need to fill that out. So vis-a-vis a loan, it's really only going to be pertinent if your people are using a hard money lender. And that's going to be usually investors. That is, once again, the short-term high loan value or high interest rate. Usually the investors and flippers trying to either for purchase or for renovations or something like that. The reason that is a reportable transaction, even though technically they do have a lender, is because those lenders are not under those same bank regulations for the reporting for suspicious activity and that sort of thing. They don't have to do that because technically they are like an investment group that's loaning their own money. They're taking a lot of the onus on themselves. Usually they'll only loan up to like 65 to 75% at the most of the property value because they just figure if you're going to default on it, they're going to take the property and sell it anyway. So they don't have the same requirements. So that's why, even though technically they would have a loan, they're considered to be non-financed for the purpose of FinCEN. They're considered to be the same thing as a cash transaction. Okay, that is a very good question. The question is, what if the buyer uses a HELOC? So this is something that we have been trying to get clarification on, because if it's our understanding at this point that if they use a HELOC, like if they don't take out like a regular first mortgage, but they're using a HELOC with the property as collateral, then it does not qualify for FinCEN. The question is, what if they're doing like a bridge loan situation where they're taking out a HELOC on a different property and then they're using it to buy this other property? Or that sort of situation. That is a question that we have not gotten an answer to yet. Is that going to be FinCEN? Not sure. At this point, what we would do as a title company in that case, we would just collect we would send the FinCEN out and just let our FinCEN people clarify whether or not that is really something that would qualify as FinCEN or not, because that's kind of a gray area. You know, if they're using a different property to actually, buy that property, the HELOC's on a different property. That's a really good question. And once we get clarification on that, we'll let you know. But if you do have that situation come up, I would err on the side of caution and just assume that they're going to need to FinCEN report. And then once again, if it goes through the FinCEN process and they're like, no, this doesn't qualify because of XYZ, whatever the qualification is, then they would get that money refunded to them. So things that are going to be ones that are going to be exempt from this.
Hey, Jules, can I say something quick?
Yep.
Well, one of the things, so I'll give you a break for a second. But there's a thing that I think people are asking too about, when it comes to private money and HELOCs and stuff like that, it gets kind of dicey. So a lot of times people will write purchase agreements and they think that they're writing them for cash, right? Because they got private money.
Yep.
But like a HELOC or something, a bank, back when the crash hit, people would shut the HELOCs off.
Yeah.
Like all of a sudden somebody's HELOC was gone. So you want to be careful to protect the buyer, because just because they think it's cash and they've got all this money laying around, if somebody was to pull back, even private money, if something happened, or if, a HELOC was cut off for some odd reason, it's not a cash purchase. And so somebody could lose their earnest money if you said, this is a cash buy, but ultimately they're really pulling a loan on the HELOC. That's not a cash buy. So just make sure to structure your purchase agreement so that you can protect the buyer, or make sure the seller's protected, that you got the right information from a buyer, right? And then title and reporting and tax reporting have their own set of, rules or regulations they have to follow. But I just thought I'd mention that because, I write offers myself as cash, and I know it's coming from a HELOC or something like that. And I'm pretty sure, like Dennis, a lot of you guys do also. So I just wanted to make sure that you understand that you can put yourself in a trap to lose earnest money. If somebody asks, I'm going to put this phone on mute again. And then if anybody has a question regarding that, I'll check in a bit. Okay. Thanks, Jules, for doing your stuff.
Thank you. That is a really good point, because that is something weird that we're seeing a lot of lately, where people are saying that they're buying in cash. And then all of a sudden we as a title company go, wait a minute, why did we just get a loan or a lender order for maybe HELOC, or generally speaking, usually it's a hard money lender. Now, truthfully, it's not, it's going to be FinCEN either way in that respect, if it's the hard money or if it's the cash. But that is, you got to be careful about that too. And once again, your sellers are going to have to fill out some stuff. The things that are exempt, if it's a 1031 exchange, it is exempt. That is an exempted organization, because it's really a flow through. So if the people, they're going to do a 1031 exchange, that's not something that's going to be FinCEN. Like I said, with this relocation one that I've got going on, the relocation one, they are double deeding it. That is weirdly reportable, even though the relocation company is just kind of passing the money through. Other things that aren't going to be reportable are a trust, if it's for the benefit of a child, or for the benefit of someone, it's someone that's disabled and there's a trust set up for them. That is going to be exempt from the FinCEN reporting. Other things that are exempt from the FinCEN reporting are things that are transferred through, like a divorce or a death. Those kind of things are going to be FinCEN exempt as well. So the biggest thing in my mind about this FinCEN thing, contract for deed. See, now that is a good question as well. What about a contract for deed? From what I have been reading, at this point, it's not FinCEN reportable. But that is another question that we have to our legal department to find out if that really is FinCEN reportable, because technically they kind of have a loan, but they don't have a loan. They're kind of buying it, they're not buying it. It's a weird gray area, because this is really geared around transferring title to someone else. And a contract for deed is like a soft title transfer. If the people who own the house are still the people who are entitled on the house, subject to a contract interest for the people with the contract for deed. So it's a very gray area. That's something that we will circle back if we can get an answer on that as well. At this point, the things that I've read, I don't think that they are FinCEN reportable, because you're not actually doing the transfer until the end. So it's not, I think that this is all geared around that deed getting to the county and them finding out, figuring out who owns it. So I don't think so at this point. Let me look at my little note of anything else that is transfer on death, individual will, trust. Okay, is this for all This is for all cash transactions. Oh, no, that's wrong. All cash transactions that are entity driven. So going to a business or going to even a trust. The thought process on the federal level is that if people are buying, then you already have their information, right? There's information that has to be taken from them at that point. So we know it's easy to figure out who is the beneficiary. So that is why there is a prevailing theory that if someone was going to wanted to buy in a trust at this point, but didn't want to have to jump through the FinCEN hoops, that they could buy as people and then quit claim to themselves, because quit claim deeds from yourself to a trust, if you are the trust settlers and the beneficiaries of that trust, are exempt. So you can transfer to a trust, and I am 99% certain you can transfer to an LLC, but you have to buy as people. CDs, they could. Contracts for deed will likely report when it's paid off. They could. I don't know. And I'm not entirely sure that that's really addressed very well within the FinCEN group at this point. Group of, regulations. I'm not sure. It could, or they could say you have to do it when you are, in the process. I'm not sure. It's kind of a weird gray area because some contracts for deed go through a title company and some don't. If you're doing a personal contract for deed, there is no reporter. So you don't have to report because there's no one to report. And that's an interesting thing about other property transfers as well. Like if you were going to buy the house from your neighbor and you knew exactly what to do and you could do your own deeds and they didn't care if you went through a title company and you didn't care if you went through a title company, you're going to give them money and they're going to give you a deed, whatever the deal is, there is no reporter at that point. So there is no FinCEN because there is no reporter. It's anything that goes through a title company, an attorney, anybody that is a qualified reporter for these things are the things that have to go through FinCEN. I mean, I guess technically theoretically you should be reporting it if you're just buying it from your neighbor, but if you're not going through a title company or an attorney or any other like formal process, if you're just giving them a check and they're going to sign the deed and hand it over to you, there's no reporter in that particular situation. So I'm not sure how that contract for deed thing is going to end up. One of the other things to note is that right now commercial is not really under this, but a commercial property that has, say, 3 apartments above it, if you sell like a condo or a property above a commercial property, even though it's technically zoned as commercial, those residential units are subject to FinCEN. The other super weird thing, which might affect you guys as well, particularly because we're in Minnesota, where there's a lot of people that are buying like hunting land or whatever, or there's a lot of farms on the outskirts that are selling out and builders are buying them. Say, if you're sitting there thinking, well, I primarily deal with, small builders. Any property that is vacant land that is presumed to be for use for building residential properties is subject to FinCEN. So if you've got a small builder, they're going to buy like a farm and they're going to build on it, that is subject to FinCEN if they are not using a regular lender. If somebody's just buying 20 acres of hunting land up north, they have no, idea that they're ever going to build anything on it. They just want like a hunting land. They're going to put a hunting shack on it. That's not FinCEN reportable. Anything that is presumed to be even future use for residential that is purchased with cash or with hard money is going to be FinCEN. So the biggest takeaway from it is the driver of it is how your buyers are paying for it. That's really the biggest thing if you're writing purchase agreements or if you're accepting clients. The purpose of the FinCEN, is that the question? The purpose of FinCEN is for the federal government to try to track people laundering money through buying and selling real estate, because it's a huge loophole in money laundering, because people, particularly with LLCs, could just buy property, cash, move money back and forth between them, that sort of thing.
Watchdog is screwing us.
Yep. So that's the reason. It's they're trying to track it, just like with FIRPTA, like I was saying before, very similar to FIRPTA. FIRPTA was around forever, but then they were like, oh, hey, this money, this 15% penalty or a tax, if you don't have legitimate status in the States, is not getting collected. If these people go back to their home country, we're never going to collect that money. That's why that's a thing for us all to deal with now. Our people, is it foreign interest, that sort of thing. Does that apply here? That's why, because they figured out, oh, hey, we can't collect that money if the people leave. Same sort of situation here. They're looking to see, hey, is this money that's going back and forth, like somebody is hiding money or they're moving money that's ill-gotten gains, whatever. That's what they're trying to do, is trying to catch people that are moving money around and either not paying taxes on it. It's money that they, are getting somehow, or it's illicit money, or it's money that, buy a house here, sell a house here, send money overseas to, some sort of a foreign terrorist, network, that sort of thing. It's all wrapped up in that. Which is why it's geared by it's driven by cash transactions or those hard money lenders, because the hard money lenders aren't looking at anything. They barely even look at credit scores. They'll do credit scores down to like 550 or something, and they'll loan people $800,000 with a 550 or credit report. They don't care. They're just going to give you money on a short term basis. They're going to charge you probably between 9 and 20% interest, and it's usually like 12 months, maybe 24 months. They're just giving them money to do the flip, to get the house, get the renovations done, get whatever they're doing. But that's why the federal government's looking at hard money lenders too, because are they really doing that just to flip, or are they moving some money around that they shouldn't be? So, I mean, that's why it's become a thing. They're just trying to clamp down on everybody that's doing the wrong thing. So the rest of us have to pay for it, basically. So as a real estate agent for you guys, that's all you're just going to need to look at when you see, when either you're accepting a client as a listing, they're going to need to know that potentially if someone's buying and they're buying in cash, or they're buying with, it's a flipper that wants to buy their house, there could be additional things that they're going to need to do and provide. And I don't know exactly at this point what happens if they don't pass the FinCEN. I don't know if there is a not pass. I don't know if that could screw up the transaction. I don't know that that's really been addressed by anybody, or if it's just the federal government goes after them directly if they feel that it's not a above board transaction, because that's what they're really looking for. They're looking for the above board scale of the transaction. So they're taking the information that the people give about who they are, social security numbers. That's why it's for the buyer, it's going to be who are you, social security number. That's why also with trusts, it's going to be not only the information about the trust, it's going to be the information about all of the trust settlers that are the beneficiaries of that trust. All of that's going to have to get provided. LLCs, that's another thing. So if you, you've got a client and they're going to buy property as an LLC, what they're going to need to provide is not only the information about their LLC, but the personal information about anybody that has more than a 25% ownership in that LLC. The FinCEN reporting starts before the closing. Yeah. Usually, I think all of us are going to do that. This is also new. We kind of don't know where this is going to go. I mean, literally it's like, oh, here's this, but it's a federal thing. So not really a ton of direction. We generally, most of us are starting the process before the end of the closing, although you do have up to like 30 days. It's kind of, this is a weird thing too about FinCEN. You have either 30 days after the closing or till the end of the next month after the closing to report. So, you do have time to report, but I think that most title companies are going to start that process ahead of time just to make sure that on our end, we're covering what we need to cover. Definitely, the buyer is going to get their information to go in and fill out what they need to do probably as soon as possible once the process gets rolling. So that's where, the people that are bobbling around with, oh, we're going to get a loan and now we're not, now we're paying cash. And now, that's going to be a big deal for people if they want to. We've had some where they were going to take out like maybe 50% loan on the property, bring 50% to the table. And then they decided to take just more money out of their 401k and just bring 100% to the table. That's going to be a FinCEN. And even if they're selling their house and they're getting enough, they're downsizing, they're selling, they're getting enough to buy their smaller property, it still is going to trigger FinCEN because they're buying with cash. So, I mean, that's where you guys have to kind of in your mind go, okay, what's the situation here? Like, what are they buying and selling, and then they're going to be able to have enough money to buy? That's going to trigger FinCEN. Are they, getting a hard money lender like Kiavi Funding or American Land Capital here in the cities is one. Any of those kind of entities is something that's going to potentially trigger FinCEN. And if those companies can show that they are compliant with the SAR requirements that the federal government has, that they have a different kind of compliance program, then the people would get their money back because the lender could show that they are compliant and that they are collecting the information they need to. If they can't, then they're going to have that FinCEN. But I don't really think that we all need to panic about it. It's the investors. If you do a lot of work with investors, this is going to hit you probably harder. If given webinar, was the webinar given by the attorney reference before available for us to review? That particular one is not. Kathy, we need to get together and find out if that is.
It's not recordable.
One that is referenceable. That one had a lot of internal company stuff, so it's not available because it's got internal company processes that they won't allow to be watched by other people. So, but we will find out if there is one that is available for you guys and see if we can get that over to you. So I don't know. Anybody else have any other questions? It's all just very, it's very new. And so it's just going to be like the FERPTA where everybody's like, oh, what's going on? And now we kind of get it. We're all just going to have to work through it a little bit because it's not very set in stone at this point, except for these certain circumstances where we know that we're going to need to do it. But what the process looks like for the people, no idea. I mean, we kind of know what the questions are. How hard that process is for them to navigate, we're not really sure. What kind of prices we're going to see from different title companies, not sure. Like I said, I just saw one from Results Title. They are charging $300. We do charge $199. We have our own company that does it, and any of our Stewart agencies as well. So if you generally use, I mean, we'd love it if you do use us, clearly. Just got to throw that in. But any of our Stewart agencies, so if you generally use a title company who has Stewart Title as their underwriter, they're one of our agencies. Stewart is making available our FinCEN team to them as well. So I think that that's going to be kind of a consideration for you guys too. If you use a smaller title company where the people are going to have to navigate through paper, it's probably going to be a harder process than an online portal where you have like a chat where you can ask people what your questions are if you've got questions on what you need to fill out.
Is there a hard fee then?
Is there what?
Is there a hard fee that the title companies are paying then to? I guess there's some kind of a fee, right? Or it's time, right?
Well, like for ours, and that's the question. I don't know if there's a fee that has to go into the federal government. I guess there probably is a filing fee of some sort. But like for our purposes, our FinCEN team, they're Stewart. They're actually Stewart employed FinCEN people. So that's why ours is like $199. It's not, I would say if you have a smaller title company that's going to use a contract FinCEN, it's probably going to be higher.
Yeah. Okay. So that's good to know. It's another thing to look out for on a.
Yeah, that's really what it's gonna affect you guys when you're doing your net sheets for people, because that's why I said I would shoot high. I'd shoot 500 on there. If you're doing a net sheet where you know that this is going to be a thing, it's somebody that's buying in cash, and you know that it's going to be a FinCEN report. But once again, it's strictly a buyer fee. So although the seller does get dragged into it, they do have to go in and fill out a little bit of that form. There's no fee for them because it's strictly driven by the buyer side and how they're buying. If they're buying, with cash in a trust or in anything that's not just people. Because if they're buying just as people, it doesn't matter. Even with hard money, if they're buying just as people, they're buying as people, and so they have to give out their social security number. Like I think most states have a requirement for that. So we have the information anyway. We as a title company have that information if they're buying as people. It's just trying to keep it's transparency, right? It's all
Yeah.
transparency of who's involved in the trusts, who's involved in those LLCs, because there's a lot of hiding behind, particularly LLCs, like this new, the make money using, doing real estate, and they tell people, every property to keep them separate. You can do like the 1700 West 82nd Street LLC. Every property has a different LLC. That gets very muddy for the federal government trying to track who's actually involved in those LLCs. So that's the big thing. It's all transparency on who's buying and selling these properties, or buying these properties, particularly with cash. That's the big thing. And so takeaway is, if you've got a regular lender, even if it's a trust, even if it's an LLC, don't worry about it. It's not going to be FinCEN. A regular lender has their own internal federal requirements that take the place of the FinCEN. They're already doing the transparency there. So it's strictly cash, or these hard money lenders, or a gift. If you've got some crazy situation where, the neighbor helped my grandma for 20 years, so we're going to gift them her property, that would be a FinCEN thing, because that would be the federal government going, why would that happen? Why would somebody just like give a gift of $200,000 property? If it's grandma that's giving the gift of the $200,000 property to the grandkids, one of the reasons that is a FinCEN trigger as well is because, did grandma report that? There's gifting that goes under I think it's up to $18,000 you can gift a year now, up to 14 million over your lifetime. So that triggers a different sort of federal oversight for what's going on with the money. So that's one of the reasons that, like a gift situation, if you did have that, because you do get those once in a while, you do get somewhere it's like, hey,
things that we run into is mom's going to gift the money. Well, mom's going to have to pay taxes, so nobody knows about that stuff. That's a whole nother segment.
Yeah.
I mentioned, I was going to mention, I see Brenda has a question, but the contract for deeds, I think about a decade ago, the state of Minnesota made a statute that required people to report them within 30 days. Otherwise, you get fined, statutory something. And so, because I deal with a handful of them, I found out myself, but I never had a
they
problem.
have to be filed within 30 days.
Yeah. So that's what I was wondering, if FinCEN was involved in that. It'd probably be like, because aren't the taxes paid at the end? Or
They are.
Yeah.
Because that's the weird thing about the contract for deed. The deed doesn't get recorded, and the state deed tax doesn't get paid until the contract's paid off. So if you have a 10-year contract for deed or a 5-year contract for deed, you're looking 5 years down the road before that's actually gonna function through. And things like the state requirement for ECRV. For a very brief period of time, Minnesota, for whatever reason, decided that an ECRV had to be done originally with the contract for deed, and now they've flipped it back to the other way, where you do the ECRV when the deed gets to the county when the contract is paid off. So it's really a weird gray area.
Yeah,
that's going to be a weird
to capture taxes.
Yeah. So, and then once again with the gifting, if I think it's been quite a while now that like the automatic reporting on the for the lenders have required that, like, if mom's going to gift money, mom has to show where the money came from, right?
Yeah.
Get some information from mom. The thing is that if mom is gifting just gifting some money, and then the kid's getting a loan, that if the loan is a regular lender, that's not going to be a FinCEN report. That's going to be an internal thing where mom's going to have to show the bank, the lender, where the money came from. It's not going to be a FinCEN report, because the kid that's buying the house is actually taking out a mortgage. So that, that requirement is on the lender, not on the title company. If it was 100% gift, the kid's not bringing any money in, mom's gifting 100%, then it's technically seen as cash. and then you're going to get a FinCEN report. All right. Well,
Oh, is that for everybody? I was sending something to Brenda to see if she still had a question.
and then Dennis wanted to know if there's a social media type of post that gives some info that you can post. I'm not sure. We will check and see if we can find something like that as well. I have more stuff for Kathy's list.
Well, we could try to keep it within 5 minutes.
I have some very helpful flyers too that I will share with you guys. And we also have a resource hub that is FinCEN related, and it tells you all about it. So in addition to Jules, you know, she is just an amazing resource for this information, and you can reach out to her anytime. But in the meantime, we'll try to find information on like an attorney video, and then what we can share through social media as far as videos. And then, but I will send flyers that we have that are like checklist related that just came out. Jules, do you want to add anything on those checklists?
I don't think so.
Okay. But the
So yeah, you'll
helpful.
have those too, because I think that kind of thing is going to be helpful for your people. Like if you do end up in a situation where you know absolutely that this is going to be a FinCEN report, well, here's the information. Here's why we need to do it, right? Just even a little flyer that says, "Hey, here, you know, this is the deal." But yeah, we are having some people that want to quit claim to themselves or from themselves, buy as themselves, avoid the FinCEN, quit claim to themselves, because a quit claim with no money transfer from yourself to an entity, usually a trust that you are actually the settler or the beneficiary of, is not a FinCEN related. So, and I think that might hold true with an LLC as well. If you are like the member of the LLC and it's your own LLC and you're going to take it from yourself to your LLC, that's not a FinCEN reportable after closing, after the original deed has been made of record. So that's something you guys are going to want to watch out for too. People asking you to help them get quitclaim deeds done. I think you're going to see a lot less title companies that want to really be involved in that, because there's going to be a question of, is the federal government going to crack down on that at a certain point and say, hey, you're helping these people kind of skirt the FinCEN rule by, you know, you're helping them get a quitclaim deed done once they've already bought the property as themselves. They're kind of skirting. That's kind of not what they knew they were going to go into an LLC or into a trust, and, you know, they did it through themselves at first. There could be a question of that. And just in general, quitclaim deeds are problematic. Most title companies don't want to do them anymore because people get an idea, they see something, they get an idea that it's a good idea to quitclaim to themselves, or that sort of to their kids, to whatever. There's a whole lot of things that they probably should talk to like a real estate or estate planning attorney about in that respect, because you can screw up like your estate planning doing that. Or we've had people that want to put their kids, I do a lot of closings for some people that want to put their kids on title. Well, their kids are minors. I mean, that's something where, you know, you could have a client that says, hey, I want to put my kids on, you know, can you help me find somebody that will put the kids on title with me? The kids are minors. Then somebody, if they go to sell the house, somebody's going to have to sign for them. They can't sign for themselves. So yeah, there's a whole lot of reasons why you shouldn't get involved in those things, because you can screw up people can screw up a lot of things because they hear one thing and they think, oh, that's a great idea. But then it turns out that they've screwed up a look back for, you know, medical liens, or taken things out of the way that they wanted their estate planning and all that stuff. But they can technically, theoretically, buy as themselves and quitclaim into their LLC or trust, from what we've heard. So,
Jules.
Yeah.
This is Brenda. Hi, Jules and Catherine.
Hi, Brenda. How are you?
I'm good. I love working with you too, because you're so accommodating. But that's I wanted to add that, but I do have a question. When you talk about the cost, you say prepare be prepared to include it in the seller net sheet. Is that the 199 that you're referring to?
Nope,
And
you're
then
going to include it in your buyer
and
estimation
the fee worksheet, not
in
the
the
seller's
fees,
net
not the
sheet.
seller,
Okay.
because the seller's not
Okay.
going to pay it. It's strictly a buyer
That's
cost.
yes,
So
that's
your
what
buyer
I
just needs
thought.
to know.
That's
Yep.
what I thought. But
Mhm.
net sheet, I think seller, fee sheet, I
Yeah.
think buyer. But you
Yep.
know, I would be very interested in getting a checklist for both the seller and the buyer, because there's a person in Taiwan that I have his property listed, and very likely it will be cash. And I want him to be prepared ahead of time. And he's an LLC with the properties, and somebody could come in with an LLC or cash, very likely. So, when do you think you'd have a checklist? I'd like him to be ahead of the game here.
That would be a Kathy question.
You should probably get them set up for you know, a remote sign right away, because the authentication process takes a little time. That's the beauty of you guys. You have
What
all the
I'm
services, and when you guys like a question like the spin sun stuff, Stewart has the answers because they have a whole corporate hierarchy that's on top of everything legally, and that's kind of
Well,
why
Yeah.
we.
well,
Yeah.
he's a U.S. citizen, but he's living in Taiwan. So my point is I need to get him advance notice on what to prepare for, because it's a bit more challenging being in Taiwan and then all of this good stuff.
Yeah, he's gonna,
Uh,
if he buys in an LLC, then he's and cash.
no, he's selling. He's
If he sells,
selling.
then he doesn't need to worry about it. So there's another question here
Well,
too. If you have a property in an LLC
didn't
name
you
right now,
say though, didn't you say that the seller also has to fill in information? What type of
only if the
information?
buyer qualifies as a FinCEN report.
I understand that. So the buyer is FinCEN, and you
Mhm.
mentioned that the seller would also need to complete information. So that's what I'm curious about. And I could be very well be helping both. So,
It's the part that the seller has to fill in seems to be pretty normal, like who you are, name of the trust if it's in a trust, is the trust under your personal social security number. A lot of them are now. Back in the day, they used to give them trust IDs, or TIN or EIN numbers. That doesn't seem to be the thing anymore. They've kind of switched to a if you have a personal trust, it's under your social security number.
he has
Um,
LLC, so it's
so
LLC.
LLC,
Yeah,
same sort
it's
of thing.
yeah.
He'd need to put in his tax ID number and the information about where the just the name, address, name of the LLC address, all of that stuff, and then his personal information as well, I believe.
That's it. Okay, I thought he had to do
I don't know
some
if he
sort of
has to do his
questionnaire.
personal. Maybe not,
Okay.
because he's the seller. But definitely if he's buying in cash, then his personal information would be needed. And also anyone that has more than a 25%, like if he's his own guy, right? But if there's an LLC that has like 3 guys in it and they each have 33%, all 3 of their information
Right.
their personal
Yes.
information would need to be in there. Anybody with more than a 25% stake in, a company like that and has beneficiary and rights and all that stuff, all of 3 of their personal information would have to be disclosed, as well as sellers, if they're buying cash or with hard money.
Randy, are your
What-
CDs through a bank that you do, or do you go through a
Oh,
bank for your contract for deeds?
if I do one, it's usually when I have the funds available to do one.
Okay, I see. Because a lot of those contract for deeds that they go through a bank, and the bank is listed as a mortgagee, and the contract for deed holder is a lost payees.
Yeah,
So
I know all
then the
about that.
person, yeah. So then that wouldn't be FinCEN, of course, because they're going to refinance with a bank. But anyway, I don't want to interfere with your conversation here.
No, it's good.
Yeah.
These are good questions. We're running
Well,
out of
thank
time
you.
here for this day,
Yeah.
but that's definitely something to talk about on a completely different. We can go on and on about how to do CDs. There's
Yeah.
huge
Yeah, I
profit
get that.
margins.
But Jules and Kathy, they're very competitively priced. I price out every time I do a loan or a real estate transaction, and they've always got the best pricing. I don't know if that'll be the case for anybody else, but I have good success and always accommodating, always ready to help.
Well,
Hope
thank you,
don't mind
madam.
if I'm particular, so I just wanted to plug that in there because you're great.
Well, we really appreciate you. Thank you very much. And we appreciate all the people on the call today taking so much time to meet and learn with us together.
So-
We're always here for you.
There was one more quick question. Looks like BJ had one that said, if you have a property in an LLC name right now, will it be a problem later when you sell it? No, it shouldn't be, because it's not it's the sell side's not going to be a problem with the LLC. It's driven by the buy side. Well, that's all I have. Anybody else have anything?
I hope you all make it a great week.
Thanks, you guys, for inviting
Thank
us.
you.
As always, we enjoy coming to see you.
Yeah, thank you very much.
Yes.
Thank you.
Thanks, Catherine.
We
Thanks,
got-
Jules.
Bye, guys.
Have a
care.
good day.
Thank you.
Bye, everyone.